Recent in news is the India and Oman DTAA. Now, what is this DTAA? It is basically what we call as the Double Taxation Avoidance Agreement. Whom does this particular DTAA impact? Now, important is that this Double Taxation Avoidance Agreement impacts both individuals as well as the entities or the companies or corporates or what we can call as organizations that are established in India, and both these are having some kind of income from India or abroad or both. We're going to discuss today in this particular video of Commerce Gyan. First of all, we will understand what is a DTAA. Secondly, we are going to talk about what type of incomes are the ones which are impacted by the double taxation avoidance agreements. Then third is what is the applicability of this DTA. So determine the DTA where it is applicable. Fourth is how do we apply this DTA to the incomes or to people, or how do we do the computations. Fifth is it possible to actually claim back the tax paid in other countries? So if you've already paid some tax in another country, then is it possible that we get a benefit when you're paying taxes in India? Then comes the countries in which India is in agreement in relation to double taxation avoidance. So which are the countries with which India has DTAA signed? And finally, we're going to take into consideration things to remember when we are considering the double taxation avoidance. So first, let us talk about what is this double taxation avoidance agreement. Very important. So agreements which are signed between India and other countries so that there is no double taxation or the same income is not taxed twice in both countries. So just in case you're a resident of UK, United Kingdom, and you have house property in India which you have given on rent, let's suppose. So what happens? You earn rent in India, but this income is taken to UK. Also, you might be paying taxes in UK. Now, when you earn this income in India, India will say this is the property in India, so you have to pay tax on this property in India itself. On the rent income, you pay taxes in India. Whereas UK would say that no, you are a UK resident, so when the money is being brought into UK, you are supposed to pay this amount of tax on in the UK also. So there can be clashes between the taxes which have to be paid. So if suppose a person gets 100 rupees from rent, 30 rupees may go to India and 50 rupees goes to UK government, then what is left in hand? Nothing, right? Not much. And this is where the DTAA will come into force, and it will help you to avoid double taxation. So what are the incomes that come under the purview of DTAA? So there could be several incomes, right, from salary income, then house property income, you can have business income, capital gains income, then any kind of interest income which you're earning in India, royalty incomes, or any other incomes that have been mentioned in the treaty or are as listed. So most of the incomes which are covered under the Income Tax Act will naturally be covered under the DTA. When is this DTA applicable? So applicability of DTA, if you have to take into consideration, then this happens when you are earning income and this income is chargeable to tax in two countries. So let's take, in this case, it is chargeable in India also and UK also. So both the countries have chargeability of tax on that income. And this DTA becomes applicable when there is one party which is involved who is actually a non-resident. So it could be an individual, a partnership, and in any other organization, or it is a foreign company. So in both these cases, if it is a person non-resident or it is a foreign company, in these cases, the DTA becomes applicable. Now, how to apply this DTA? So what you have to do now, when you're actually checking up whether the DTA is applicable and whether it can be used in a particular circumstance, what we have to see if there are income tax rates of taxes on that particular type of income. So what is the income tax rate at which this particular income will be taxed? Second, we have to look at what is the tax in that agreement between two countries which is levied on that specified income. So Income Tax Act will have a specified rate of taxation, and also double taxation avoidance agreement which is signed between these two countries will also have a specified rate of tax which will be charged on that income. So both what we do, we compare them, and then we will finalize the tax rate which can be actually beneficial in that case, to the individual or to the company, whatever is better in income tax or in the case of treaty, so whichever is lower, naturally the income tax or DTA, we are going to take into consideration and charge the tax in accordance. Now, how to claim the double taxation avoidance agreement benefits. This is a very important section part. Now, there are several methods by which you can actually claim the benefits of DTA depending on whatever is allowable as per the DTA. Now, the first method is a tax credit method. What is a tax credit method? Suppose you have paid taxes in a particular country. Let's say you have paid in USA and you are in India. So whatever tax was paid in the USA now can be adjusted to the taxes which you are actually paying in the Indian income. So suppose your income tax payable comes to 1 lakh and you have already paid taxes of 30,000 in the USA, then you have to pay only the differential amount of 70,000. So this is where the tax credit method comes into picture. Second method that by which the benefits of DTA can arise and can help the taxpayer is the method of exemption. That means according to DTA, they would say that taxation or the tax will be charged only in the country of origin of income, or it could be charged in the specified country, whatever is listed out. So if in the case of agreement between India and Japan, Japan says that if you have a rental income in India, right, then if you have to pay tax only in India, you don't have to pay tax in Japan. So any person who brings this rental income from India to Japan does not have to pay tax. So basically, one of the countries will have an exemption from payment of tax in the case if there is a DTA signed in that specified regard. Third method of claiming the benefit of double taxation is by way of reduction or deduction, as we call it, where if you have paid some tax of a particular in a particular country, then this tax will be reduced from your total income, and whatever remainder income is there, you pay tax on it. Now, I think this won't be very clear with just an oral explanation. So I'm going to give you an example to understand each of these methods in detail. Look at this particular example for the methods. If you take the first part, that is, we are talking of the rent income. So rent income uniformly, we are talking of 1,000 earned in all the three cases: tax credit method, exemption method, and deduction method. Okay. In the case of foreign tax, I'm assuming 10% taxes. So in all the three cases, you will have 100, 100, 100 of foreign tax charged. Now, domestic income, when you're considering under the tax credit method, the domestic income will be 1,000 only. So you're going to charge tax on 1,000. In exemption method, since already there is some amount which is charged in another country, you don't pay any taxes on this particular income of 1,000. So that becomes zero. Deduction method, you will have the 1,000 amount of rent income minus the foreign tax 10% which was paid 100 rupees. So 900 will be your taxable domestic income, because in deduction you deduct the tax which was already paid. In the domestic tax case, you are paying, let's say, 30%, assuming a tax rate of 30%. So tax credit method, you will have 300 rupees of domestic tax. Exemption method, no taxes, and deduction method, you will have 270 of tax. On 900, you charge 30%. Now comes the credit, that is, whatever taxes were paid in another country, you can claim them as credit under DTAA. So here in the first case of tax credit method, from the 300 rupees, you reduce that 100 rupees and final taxes payable would be 200. In the exemption, obviously no DTA credit can be claimed because you're not paying taxes, and final tax payable will also be zero. In the case of deduction method, you will have no credit benefit. You just pay 270 rupees in the domestic taxes. So in the case of total taxes paid, now if we take a cumulative total amount of taxes which was paid in each case, in the case of tax credit, you are paying 300. In the case of exemption method, you are paying only 100, which was the tax which was in the foreign country. And in the deduction method, you are paying 370 rupees. So in this example, where the foreign taxes were lower, the exemption method stands to be the most beneficial. and most costly is the deduction method. This may not be true in each and every case, but this was just an example to show how these methods work. So in certain cases, exemption method may be better. In certain cases, tax credit method may be better. It depends on case to case what is the most beneficial. But this was just to explain how these three methods Okay, now coming to the next part, that is how many countries does India have the double taxation avoidance agreement? Now, nearly 100 or more than 100 countries we are having DTA agreements, and some major countries to mention, you can say they are USA, UK, Germany, Canada, Japan, China, etc. So these are the major countries which we can list out for the purpose of DTA agreement signed. Now, one important thing, what we just spoke about, the India and Oman agreement, which was the DTA, which was being discussed in the news in the recent time periods. This was not the first time that India and Oman signed a DTA, but this was an amendment. And in each case, India keeps amending, or even other countries keep amending the DTAA. So basically, depending on trade circumstances, depending on the situations, the cordial relations or bad relations between the two countries would have an impact on DTA. And amendments can impact the people who are claiming the taxes, claiming the benefits, or who are being charged to tax in both countries. So this is where the amendments come into picture, and they also affect the people. Finally, we are coming to the part where we have to look at the things to remember when you're talking of DTA, double taxation avoidance agreements. Now, if at all, let's suppose, if at all the treaty does not talk about any particular income, so the DTA does not speak about any kind of income, but Income Tax Act, which is in India, says, okay, this income is chargeable to tax at a particular rate, then Income Tax Act will be naturally prevalent. We will have to look at the income and the taxation on the basis of the Income Tax Act. Second is, if at all the treaty includes certain provisions but nothing is mentioned in the income tax. Okay, there could be a possibility that things are mentioned in the DTA but nothing mentioned in Income Tax Act. Then obviously we will have treaty which will act as the guiding principles, and we will have to follow the treaty for the purpose of taxation. If an important thing here is, if Income Tax Act also has things stated about the income, and if the treaty also has certain things mentioned about the income and the taxes, then whatever is the most beneficial we will take into consideration from the assessee point of view, not from the income tax point of view. So whatever is beneficial for assessee, for the individual, for the foreign company, they will take it into consideration as per their benefit. So DTA is meant for this purpose, that if income tax and the DTA both have things mentioned in common about a certain type of income, then obviously whatever is beneficial for that particular assessee, this is what will be taken into consideration. So just for an example, if the UK and India DTA, we say UK is charging rental income at 10% and India is charging rental income at 5%, just for an example. So which is most beneficial? The most beneficial mentioned in DTA is 10%, and in Indian case it is 5%. So beneficial is 5%. So we consider 5% only for the purpose of taxation, right? And finally, if the treaty and income tax have contradictory provisions, so if income tax says a particular thing, yes, you have to charge the tax, and if the treaty says no, you don't have to charge the tax on this foreign income, then the treaty will prevail. So treaty has to be considered as the basis for charging of income. If nothing is mentioned in treaty, then income tax prevails. If nothing is mentioned in income tax, then treaty prevails. If both speak same things about something about that income but not in contradiction, then whatever is beneficial for the assessee, that is prevalent. And finally, if they contradict each other, the DTA and income tax speak in opposite directions or different directions, then we will consider the treaty as the basis, as the guide. Okay, so this is what we have to remember in DTAA agreements. So hope this particular part of double taxation avoidance agreement is clear. And since the since the India and Oman DTA agreement was prevalent recently and it had come up in news recently, I thought I would explain to you the double taxation avoidance agreement taking into consideration this news which you may be following for the purpose of your studies. So, hope this particular video helps you in getting a perspective on this topic. And if you like this video, do share it with people. And if you're not still following Commerce Gyan, do follow and do subscribe this channel, because I will be sharing with you insights about different areas or news things and case studies about commerce, the current affairs related to commerce industry, and I will be talking about different subjects also, like accounts, commerce, law, and any amendments which are of key importance to people who are students as well as businessmen, or who would be taking into consideration, who would be interested in understanding commerce, investment, and other such knowledge. So hope to see you in the next video of Commerce Scam. Thank you.